Time group today. How's the coffee going? Good. Have you put a little card on one of those spuds there? I took J. What did I take? No, 9J. I might go back and stick another one under a nom de plume, see if I can increase my chance at the prize. I like that idea. We've got a couple of prizes around with our exhibitors today, which is good fun. There's also, as I was coming in, just probably waiting for the couple more to come through the back there before our first presentation. There is a booth as you come in the main door on the left-hand side, and it's probably not one that a lot of you would wander over to because it has not really a lot to do with the world that we're in with oil and gas, etc. The guys are called TLG, so it's Teach, Learn, Grow. Did anyone actually see them or catch up with them? Okay, so you know what it's about. So they're here because they're looking for investment. They're actually looking for some of the bigger companies to invest in them and help to fund them. But I was thinking too, as smaller investors, and perhaps this could be your humanitarian side project, if you like, they're looking for funds. What they do is they go out to regional and rural Western Australia and they help kids in those areas who need some help to get up to speed educationally. It's run by volunteers. It's uni students who go out and they do the teaching, not necessarily teaching students, but just students who would like to give back. And they've got this fabulous group of educational people behind them who work in tandem with schools, etc., to get programs up and running. It's a really great idea. And if you want to pop by and say, at least say hello to Hannah, say Chrissy did actually mention you to us and good luck in the future. You don't have to give her money, but give her a bit of support. That would be great. And if you're on your travels around WA and you perhaps see go into one of these smaller communities and you see kids struggling, say, hey, I know about TLG. They might be able to come out and help you as well. So it could be a win-win situation. Because, I come from Kalgoorlie and we're a pretty big centre there, but with all the travelling I do with the TV shows, etc., and with different mining companies too, you come across these little tiny communities. And often a lot of people too out in stations, etc., where they're having to move into bigger communities to give their kids a better chance. There's a really good program here in Western Australia for retired teachers who travel around and they go to stations, etc., and they work out there helping the kids on the stations to give them face-to-face teaching, which is a wonderful idea. But that one is TLG. So go and have a chin wag to Hannah. Right. Are you ready for this? We have got 8 presentations. We're top and tailing with 2 informational presentations for you to give you a little bit more of an insight into the current economic climate that we are in at the moment, and also the potential for oil and gas, etc. The first one is on CO2 storage and oil resource potential of residual oil zones in Australia. Now, I did try to catch up with the great Dr. Aleks Kalinowski so I could find out more information. Aleks, did you end up here in the room? You did. Oh, thank goodness for that. Okay, great. I'm so sorry. I saw you come in and sit down and I wasn't sure. So welcome. I haven't had a chance to have a chat with Aleks, but would you please make her welcome? She's got a really informative speech for you today, and I know that you're going to be so better educated when it comes to having a look at our next presenters and looking at your own portfolio in the future. Please make her very welcome.
Thank you very much, and I appreciate you coming in after lunch. I'll try not to put you to sleep too much for the first session of the day. So today I'd really like to tell you about some of the work that Geoscience Australia is doing with CO2 storage, and in this particular case, it's CO2 storage and oil resource potential of residual oil zones. And this is a project that GA is leading in collaboration with CSIRO, and we've also had some great input from industry, in particular Bridgeport Energy and Beach. And all of this work is being done under this broad umbrella of the Exploring for the Future program, which you may have heard of. It's a $225 million pre-competitive geoscience program that's looking at mineral, energy and groundwater resource potential in Australia. Which button am I waiting for? The green button? So that's the... Should have worked out how this works first. No? Sorry. Oh, big one. The big green button. Sorry, the really big green button works. Okay, fantastic. So some of this is going to be probably pretty basic for you, so just sit through it. What we're looking at is residual oil zones. So these are water-saturated reservoirs that contain some immobile oil that could be produced through CO2 enhanced oil recovery. And we have 2 key aims of this project. The first is to identify whether we actually have these things in Australia, at a scale that's large enough to be potentially produced. And if we do have them, how much CO2 can be stored and how much oil could be economically produced from them. So the drivers for us, really, the fundamental driver is really meeting our emissions targets and through accelerating carbon capture and storage. The other driver, of course, is maximizing our oil resources domestically. So on the left there, you can see there's a map of a number of projects, CO2 storage projects and CCUS projects that are just popping up all over the place now across Australia. We've done a lot of work to support this type of acceleration of CCS through looking at saline aquifers for CO2 storage, as well as depleted fields. And now we're looking for other options that can help build up our portfolio of storage sites. And that includes through CO2 enhanced oil recovery in depleted fields and also in residual oil zones. And of course, CO2 EOR offers a way to maximize our existing oil resources that we are producing now, that we know about now. For those who aren't familiar, CO2 EOR is a technology that's been around since the 1970s, and really it's where CCS started. And it's used to improve the yield of oil from oil fields and extend the life of oil fields. So we know that primary production can result in, perhaps 40% of the original oil in place being produced. Water flooding can result in another 10 or 20%, site specific, of course. And CO2 EOR can also produce some 10 to 20% of that oil. And the way it works, you can see on the picture there, CO2 is injected into the reservoir where it acts like a solvent. It helps move some of that oil to a producing well. The oil and some of the CO2 is produced, CO2 separated and recycled in this process. And the important thing here is that, CO2, actually, some of the CO2 remains in the reservoir and is trapped. So this is kind of a pathway to CO2 storage. So we started looking at CCS. CO2 EOR is really common in North America and other parts of the world, but it's not very common in Australia. And we really wanted to know what is the potential for CO2 EOR deployment for this industry in Australia. And so a few years ago, we had a look at some of the key oil basins in Australia, and we looked at geological factors, we looked at oil composition, we looked at the fields and how big they are and what status they are. We also looked at infrastructure and the availability of CO2 now and into the future. And we kind of ranked some of these regions, very broad brush, but we generally found that there's quite a lot of potential for CO2 EOR in Australia. And of course, we're coming at this from the point of maximizing CO2 storage. So we looked at, well, how much CO2 can you actually store through CO2 enhanced oil recovery? On average, CO2 EOR projects store between 0.3 to 0.9 tonnes of CO2 per barrel of oil produced. Obviously, it depends on your aims for your project. So if you want to minimize the amount of CO2 you're using, you're at the lower end of that spectrum, which is understandable because CO2 is very expensive. But if your focus is on storage, then you can be at the higher end of that spectrum. And we realized that for achieving carbon neutral oil, if you use more than about half a tonne of CO2 per barrel of oil, you're actually able to achieve that kind of carbon neutrality. So depleted fields are one thing, but we sort of thought, well, where else could you use CO2 enhanced oil recovery to actually accelerate deployment of CCS? And residual oil zones came to mind. And this is largely because this has really taken off in the United States. So we're looking for geological residual oil zones. These are naturally formed. They're water saturated reservoirs that typically contain between 10 and 30% oil saturation. They can form in this brownfield setting, so beneath the conventional accumulation. They can also be found in greenfield settings where you don't have a main pay zone. The advantage of them for CO2 storage is that they're really large and they can store a lot of CO2. And they can form in a number of different ways. In Australia, we find that the ones that we see are typically formed through tectonic tilting, breach of oil traps, and thick transition zones. And this is a real resource. So this is some examples from the United States. The Seminole oil field on the left there is a brownfield example. And this one really helped play a key role in the commercial development of residual oil zones. So this field has undergone 4 stages of production since 1936. You can see the 4 different peaks there: primary, water flooding, CO2 enhanced oil recovery in the depleted field. And then the red line there represents the projected oil production from the residual oil zone, which is something like 225 million barrels, depending, of course, on CO2 availability. And on the right there, you can see the Tall Cotton Field, which is the first residual oil zone that's been produced that does not have a main pay zone. So it's actually quite a thick residual oil zone, 91 meters, with a fairly high oil saturation of about 30%. And after about 4 years of injecting CO2, they were producing 3,000 barrels of oil per day. And Kinder Morgan expects this to form a major part of their portfolio. So we're not expecting to find a Permian Basin here, but we did have a look at some areas that are strategic to the Exploring for the Future program, and to see if we can find these residual oil zones here. So we looked at the Amadeus, Simpson-Pederka, Bowen Surat, but we really focused on the Cooper-Eromanga province because that is a large oil province. And also we have really good data there so that we can really test our methodology and our approach. And we developed a workflow. It's pretty straightforward. I'll show you with respect to the Cooper-Eromanga work that we did. Really, the first few steps involved looking at all of the fields, cutting out things that we're not interested in, like purely gas fields, unconventional fields, and also fields that were too shallow for oil miscibility with CO2. And then we put those remaining fields through a geological screening process. So we looked at composite logs, we looked at any mentions of residual oil zones in literature and well completion reports, and also looked at sort of the petroleum system in general. The ones that made it through that process, we put through to a petrophysical analysis. So really here we're looking for qualitative indications of residual oil zones and then trying to quantify the oil saturation, mainly using resistivity logs. So this is the typical way to look at oil saturation, of course. Saline water is conductive, oil and most rocks aren't, and so you can really work out how much oil you might have. And we used a typical Archie analysis for most of the clean sandstones, and then we used a modified version of that for sandstones where we have a high clay component that can be quite conductive. The ones that made it through that process where we actually found some evidence of a residual oil zone, we looked at matching that petrophysical interpretation with evidence from shows and tests. And this is using Geoscience Australia's classification scheme here. And you can see some nice fluorescing core there, but we have some oil shows in the sandstones. And finally, we ended up with a bit of a map that shows us where we have confirmed residual oil zones, where we have some plausible or possible residual oil zones, some places where we require further investigation, some where we absolutely know there is no residual oil zone, and there's a bunch of others that we just didn't get to for time, or we didn't have the right kind of data to do the assessment. And this is an example of what our analysis looks like. And if you just focus on the two logs I've highlighted there, there's the resistivity, and then on the right, there's the oil saturation and the shows as well alongside that, so you can see how they compare. This is an example from the Dullingarry field, so one of the bigger ones we looked at, about 50 million barrels. And you can see from the petrophysics and also supported by the shows, we've got main pay zones in the Namur sandstone and the McKinley member, and strong shows at the base of that main oil column, a small transition zone with some shows in the cuttings, and then a confirmed residual oil zone that actually can be seen across multiple wells in that field with an oil saturation of between 15 and 30%. And then we have some sort of weak oil indications below that that probably aren't part of that. Another example from a smaller field, Boland Field in Queensland. Again, just looking at those two key columns there. We have the main pay zone with a high oil saturation, so 60%, and also supported by shows. We have a transition zone with 20 to 50% oil saturation, again with shows, and then a confirmed residual oil zone with about 10 to 20% oil saturation. That's quite nicely defined there in that little blip that you can see here. So this work that we've finished now, largely, this first screening work, we're in the process of producing all the reports, and all of the data and all the interpretation that we've done is actually going to be available. So you'll be able to download it all and have a play with it yourself and see what we've done and see if you agree. And in fact, please get in touch because we're really interested in having some feedback on this work. What we're looking at now is answering the second part of our project aim, which is really quantifying this. So how much CO2 can actually be stored through this process and how much oil could be produced. And we're undertaking this through a number of experiments, core flooding experiments. We're doing some conceptual reservoir modeling, PVT analysis and compositional simulations to really try and understand these reservoirs. And the aim is really to build these predictive tools around oil production and CO2 storage and then apply them across Australia. So you can go anywhere and have a look and apply this methodology, this workflow, and some of this quantified information. The other thing we're doing is we're really integrating economics into this. This is not just a geological sort of exercise. We know that we need to cut costs when it comes to deployment of CCS. So we're really looking at transport storage costs particularly, and with the CCUS component, looking at obviously the oil price and the potential financial incentive from CO2 EOR. And that will be all delivered via an online tool, along with some of our other sort of economic fairways tools that we have developed for hydrogen and for mineral exploration. And you can find lots more information on our website. You can go to Exploring for the Future, or our AFA project, which is Australia's Future Energy Resources Project, under which this work is all being done. We have a number of publications that describe our workflow and our methodology. And as I mentioned, all of the work that we're doing now is all being publicly released and will be released in the next few months. Please do get in touch also if you're interested in this work or in any work on CCS and hydrogen. We do quite a lot on that. And we're very interested to hear from you, from industry, around some of our findings and our approach to sort of gauge whether we're really on the right track with these things. So thanks very much.
Thank you so much, Aleks. And my apologies for not getting to you during the lunch break today as well, to have a chat about that beforehand. Thank you very much. And no stairs on that side. That's where I push people off, so you have to come this way. Okay, now our next presenter today, you remember Brendan from TMK this morning, who managed to do his presentation with his torn biceps before he went into surgery. So he had an unexpected, presenter also faced an unexpected, fallen very, very ill. 48 hours ago, he was really looking forward to today and presenting, but he's fallen so sick that Calima has had to call in a sub for Mark Freeman. They've managed to track down Justyn, their MD, who was actually on the other side of the world about to board a plane, but he's gone and he has recorded the presentation for you today, which he is obviously very, very passionate about. So Calima, for your information before we start, has had an almost 20% quarter-on-quarter increase revenue to 37 million in Q2 CY 2022. I think their focus on the Canadian gas and oil assets seems to be paying off. Would you please welcome the sub, Justyn.
My name is Justyn, and I am the President and CEO of Calima Energy Ltd. I'm here to present our story for you today. So Calima Energy Ltd is a Australian listed ASX company with assets focused in Canada, in Western Canada. And we're a returns focused growth producer with top tier assets in the Western Canadian Sedimentary Basin. We have positive cash flow and we're very ESG goal oriented. Our trading symbol on the ASX is CE1, and we also trade in the US on the OTCQB under CLEMF. We have 612 million shares outstanding. Our current share price at 14 cents Australian gives us a current market cap of about $83 million Australian. We are in the process of paying a half-year dividend of 2.5 million Australian, which is annualized for a yield of about 5%. We have proven, probable, and possible reserves across our asset base of 15.6, 20.4, and 24.4 million barrels, respectively, as well as a 2C contingent resource in the Montney play of Northeast British Columbia, with 160 million BOEs in the ground on a contingent resource basis. So between our two asset bases, we have de-risked assets in both Brooks, Thorsby, and the Montney area, all of which I will describe in more detail on future slides. We have free cash flow generation. We have excellent operating netbacks, and our Montney liquids-rich gas play is very scalable, and our existing infrastructure has the ability to get up to greater than 10,000 BOEs per day of production. So we are a conventional oil and gas producer. This is a map of Western Canada showing where our three core areas are. Again, Brooks and Thorsby, those are our producing assets in the province of Alberta. In that area, we drilled 7 wells in 2021. And in Q1 of 2022, we drilled another 7 wells in Brooks and Thorsby. And in 2022, in the second and third quarter, we have another 4 new wells drilled in the Brooks and Thorsby area. Then the next province over in British Columbia, in northeast British Columbia, we have our Montney Fairway, and that is where we have 34,000 acres of liquids-rich gas prospective land that we will go through in some greater detail. Current production for the company is about 4,200 BOEs per day. 65% of that is oil. And our EBITDA for Q2 on an adjusted basis was $22.6 million Australian. This table shows some financial information as well as production for our actual results for the first half of 2022, as well as the projected results for the second half of 2022, and then they're summarized in a total on the far right-hand side. Sales revenue is $136 million projected for the year between H1 and H2. And adjusted EBITDA is $78.6 million for, again, for the year based on the H1 actuals and H2 projections. Free cash flow for the year is estimated at about $15 million in 2022. This is a snapshot of our management and board. So our team is based in Canada, in Calgary, Alberta. As well, we have directors in both Canada and Australia. We have 2 Australian directors and 3 Canadian-based directors on the Calima board. So our corporate strategy is really to leverage, we have a portfolio of quality assets that generate free cash flow, and it's that free cash flow that we're using to not only grow the company through potential accretive M&A and further drilling, but we're also providing returns to our shareholders via our 5% dividend yield, which is on an annualized basis based on our $2.5 million current dividend. And then also the organic growth through continued drilling in both Brooks and Thorsby, where we have assets that have quick payouts and excellent economic returns. We're going to go through those on an upcoming slide for both Brooks and Thorsby. From a valuation standpoint, Calima offers some extreme value relative to our Canadian peers. These 2 graphs here show on the left-hand side our enterprise value relative to our daily production. As you can see, Calima is on the far right-hand side of this graph, comparatively to some similar sized companies here in Canada that are trading at a higher EV to production rate. So Calima, trading on the ASX, has a very attractive valuation in this respect, and then also on a reserves basis. So we'll go through in more detail our 2 core areas, starting with Brooks. In Brooks, we have 2 formation targets known as the Sunburst and the Glauconitic formation. These are both shallow targets at around 1,000 meters deep. And as a result of the shallow nature, these wells drill quickly, and they also come on production in a relatively quick time fashion, particularly the Sunburst, as it does not require any hydraulic fracturing to to bring those wells on production. This slide shows you an average timeline of bringing on a Sunburst formation well in the Brooks area. This map shows our land base. We have 108 net sections, or 69,000 acres in the Brooks area. It shows where we have drilled recent Brooks wells over the last 18 months in our Gemini and Pisces ongoing programs, as well as it shows our infrastructure footprint, where our oil batteries are, and our associated pipelines for gas takeaway. We've internally identified 140 net locations in the Brooks area across our asset base in the Sunburst and Glauconitic formations. However, only 31.75 of those wells have been booked in our reserve report across the Sunburst and Glauconitic formations. And you can see the reserves detail in the bottom left-hand corner. Based on those 31.75 wells booked in the reserve report, it's about 10 million barrels of 2P reserves in the ground. We've also got a water flood in the Brooks area as part of our ongoing enhanced oil recovery initiatives to lower declines on our existing production and increase reserves. So we have this water flood in the Countess J2J pool, which has been working quite successfully. It's in its infancy, but we are seeing very positive response in our initial results there as part of our enhanced oil recovery project. The economics of our two play types here, again, the Glauconitic and the Sunburst formation. The Sunburst is the true conventional unfracked on the right-hand column. $1.3 million of CapEx to drill, complete, equip, and tie in a Sunburst well. That gets us about an 8-month payout at $85 WTI. And then to the left of that, the Glauconitic formation, $2.6 million all in for drill, complete, equip, and tie in. And that gets a payout of right around 1 year or 13 months based on $85 oil. Moving on to our other core area of Thorsby. Thorsby is still a shallow target, albeit a little bit deeper than Brooks at 1,300 meters true vertical depth. It is a fracked play. We are drilling multi-stage fracked horizontal wells. We got some pictures there showing the large operation involved in fracking these wells. They do take a little bit longer to drill and complete and to clean up, but still a relatively short time frame from the initial investment of capital when you spud the well through to when you start to see production and the wells reach their peak rates. It's still a relatively quick turnaround. This map shows our Thorsby land position of about 63,000 acres or 98 net sections. The Blacksburg team has drilled 15 wells to date in this area. We have 86 locations identified internally in the Sparky formation in the Thorsby area. However, only 24 Sparky wells are booked in our reserve report, and we have approximately, again, 10.4 million BOEs in the ground of reserves based on those 24 booked Sparky locations in our third-party reserve report. We also recently completed the Leo 4 well in what we call North Thorsby, which is some undeveloped acreage to the north of our Thorsby main pool. So that well has just recently come on production and is undergoing testing to evaluate the viability of a further development on our undeveloped North Thorsby acreage. Economics for the Sparky formation at Thorsby used at $85 WTI. It's about a $3.7 million CapEx for drill, complete, equip, and tie in a Sparky well at Thorsby. And at $85 oil, that's about a 10-month payout for a typical tier 2 type curve well in the Thorsby area. Last but not least, our Montney position in Northeast British Columbia. We have 100% interest in 34,000 acres of undeveloped land in the Northeast BC corridor in the Montney Fairway. Calima has drilled two test wells, horizontals that have been completed and tested and are sitting awaiting tie-in into our 100% owned facility known as the Tommy Lakes facility. And that will all be part of a future development here in our Montney acreage. There's 160 million BOEs in the ground of 2C or contingent resource based on a third-party evaluation. And there's been a significant amount of consolidation around our Montney acreage as well. This slide shows a number of companies that have been consolidating Montney acreage, moving north towards the Calima land block, and as well drilling a number of wells that have been getting significantly better results as time goes on. So everything is working in the favor of Calima to either find a partner or possibly an outright sale or some kind of a joint venture to develop this large scale liquids-rich gas resource here in Northeast British Columbia. Calima, of course, is committed to responsible operations. We like to showcase our environmental, social, and governance policies and activities across the company. That has always been a focus for the company and will always continue to be a focus for Calima and its subsidiaries such as Blackspur and Calima Canada. So this slide just highlights some of the initiatives that we have worked on and are working on currently with respect to ES and G. Finally, in summary, we have production. We're producing about 4,200 BOEs per day for the second half of H2, and we're continuing to drill to support that production. And we will continue to have growth. We plan to continue to grow production across our two main producing asset bases through 2023, as well as the potential for significant growth in the Montney area of Northeast British Columbia, where we have the capability of ramping that asset up to about 10,000 BOEs per day of potential Montney production. We are also looking at acquisitions to grow through acquiring assets in both Brooks and Thorsby and other areas. So we will potentially execute on strategic acquisitions as some further growth. And we're in an excellent position with the production and net cash on the balance sheet for the remainder of 2022. I thank you all for listening today. Our contact information is shown for our Australian and our Canadian offices. And thank you for joining me today at the RIU Good Oil Conference.
Thank you. Not a bad work around there from Jordan, considering he's in an airport somewhere on the other side of the world. Thanks so much. Now, again, Mark sent his apologies. He's pretty confident that that information and the opportunities will speak for themselves. If you'd like to do some follow-up with a real live person, though, Jerry-Ann, did you make it into the room for the presentation? So she's still outside the booth, but Jerry-Ann is there and she will have a chat with you as well if you don't. But you can always ring that number and have a chat to them as well. All right. Our next presentation today comes from Talon Energy Ltd, which has a focus on onshore exploration and development in the Perth Basin and also in Mongolia. And yes, they are also the joint venture partners with Strike and TMK Energy, who we heard from earlier on today. So there's a lot going on, and as we've heard, a lot of upside on those joint venture projects. At the moment, they're forecast to have a $30 million a year free cash flow, and that's starting in Q1 next year. And that's actually approximately 50% of their current market cap. They will be funded. They will be ready to go. So they tell me. Let's get Colby Hauser up here. He's Talon's managing director. He's an experienced, come on, walk and talk. I'll talk, you walk. He's an experienced energy executive with a broad range of experience in senior corporate, commercial and project development roles in the energy sector, both here and also overseas. Let's make him welcome today.
Thanks very much, Chrissy. Colby Hauser is the name. Thanks for that. I just want to say quick thank you to RIU and Vertical Events for putting this event on. It's outstanding to have this opportunity to connect with peers and small emerging energy companies and get in front of some investors. I think it's been a great buzz today, and it's a good place, a good time to be in energy markets right now. So I've been to this conference many times. I've sat in your seat, sitting there trying to hang in there for some lively presentations on seismic lines, amplitude response, drilling logs, and of course being undervalued by the market. So I'm gonna not do that to you today, and I'll present just a quick corporate overview and 4 distinct investment themes that hopefully should resonate. Usual disclaimers, not financial advice, forward-looking statements, and resource information across our portfolio. So, as mentioned, I'll introduce the company and the portfolio just to set the scene for some investment highlights. Our shares, after a recent 20-to-1 consolidation, we have about 440 million shares on issue. That gives us a market capitalization of about 66 million at our current sort of 15-cent share price. That would sit somewhere in the middle of our peer group here today. Institutional support, we're lucky to be supported by several respected institutional funds in our top 20. Neuro Resources Fund, McCusker Holdings, and Precision Opportunities Fund sit as our top 3 shareholders respectively. Our cash position, we had $10.1 million in the bank at the end of June 30, after raising $13.5 million earlier on in the year. Of course, we sit somewhat lower than that now, and most of those funds are earmarked for long lead items, well completions, and other sort of developments across our portfolio. So with approximately $7 million in upcoming CapEx, we have line of sight to revenues in Q1. And we're focused not on diluting the stock, so we want to bring some debt into our capital position. Our conversations with debt lenders are pretty well advanced, and we hope to finalize that in the next couple of months to cover off project CapEx, project contingencies, and other corporate costs. So our portfolio is diversified in terms of geography, but also in terms of its development profile. Our working interests are spread across 2 jurisdictions, Perth Basin and Mongolia, respectively. One is recognized as a mature basin, and one is starting to be recognized as one of the most prospective basins in the world. We work with strong joint venture partners. In the Perth Basin, we hold a 45% interest in the Walyering project. Walyering is a conventional gas and condensate project that's recently taken FID, and our partner Strachan Energy have proven themselves as one of the best explorers in the Perth Basin. Condor, our other field in the Perth Basin, we own 100%. We're just excising that out of EP494, and that should be completed in the next few months. And in time, we might look for an operating partner with a similar profile. In the South Colby Basin, we are earning a 33% interest into the Gervante CSG project with operator TMK. You heard from Brendan earlier today. TMK have excellent knowledge of the basin, very capable in-country team, and importantly have significant local ownership, which is very important in Mongolia. So in summary, our non-operated position means low corporate overheads, contributing to a really capital efficient business model. So capital efficient business model doesn't mean we've been sitting on our hands. As touched on, the last 12 months have been very busy for Talon, and in conjunction with our joint venture partners, we've been making it happen. In the Perth Basin, we drilled 2 conventional wells, had 2 discoveries, flow tested both those wells, and announced FID on Walyering. And in Mongolia, we drilled 4 CSG core holes and tested those. And we have over 250 meters of gassy coals intersected. So this allowed us to de-risk our asset base and build a great foundation of reserves and resources across various stages in their development, which I'll touch on later. So speaking to investment themes, I've already snuck the first one in there, and that's a capital efficient business model. We have preference for non-operated position on great projects with a high equity interest, where we can use cash flows to further develop our portfolio. And our most significant investment highlight, as introduced, is that near-term cash generation, right? So we're talking $30 million per annum net to Talon, starting in Q1 2023. Is really a game changer for a company our size. $30 million, as is more than enough to keep the lights on. And to put it in perspective, on 100% interest, you could drill and test 3 wells in the Perth Basin, almost 100 core holes or 33 pilot wells in Mongolia, right? So that really sets us up to be in a strong position. And if cash flows isn't that exciting for you and you want exploration upside, we have that in spades. We have Condor, which is a Jurassic wet gas project. It's the largest untested Jurassic wet gas structure in the Perth Basin, and obviously a significant, multi-TCF opportunity in Gravantes, right on the doorstep of the Chinese market. And then finally, we have some near-term value catalysts. As we move from exploration into production, we hope to re-rate. Oftentimes, your balance sheet is transformed with those cash flows, lowering your cost of capital, and you can see a premium attributed to those companies that have done that. So let's drill a little bit deeper into the Walyering project itself, and we'll touch on how we got there. So basically, we tested Walyering 5 and 6 in the last 12 months. Walyering 5, tested very well. 75 million standard cubic feet per day. And if you're listening to Darren's presentation earlier on, my flow test is bigger than yours. That's the 5th biggest in the Perth Basin. So, and for the record, that was choke constrained. So, Walyering 6 also tested really well at 35 million standard cubic feet per day. That's well beyond the nameplate capacity of the production facility. And we've had risk recently certified what is a really great resource space for the project, 102 PJs of gas total, with a 2P reserve of 54 PJs and over 1 million barrels of condensate, total condensate, with a 2P reserve of 550,000 barrels. So that'll give us just about 5 years of production. So our third investment theme is exploration upside. We'll go back to the Walyering project in more detail. FID was announced by the joint venture only 3 weeks ago. It's one of only a few projects to take FID in this calendar year. We have a local procurement and fabrication strategy focusing on modular construction, which will give us anticipated first gas of Q1 2023. So the facility will have a nameplate capacity of 33 terajoules per day and 300 barrels a day of condensate production. And the forecasted operating costs are without a doubt in the lowest quartile of onshore production costs, and combined with a low capex, it's high margin basically. I think that our share, of $14 million capex, $6.5 million, our payback period is in 3 to 4 months, right? So, as Strike put it earlier, it could be, the highest IRR project in the country. So focusing a little bit more on those cash flows, with Jurassic wet gas, you get 2 revenue streams. One, you get on a long-term take-or-pay contract, and the other, you get exposure to a global market with opportunities for a pricing run. So we've seen gas price surge in spot and long-term contracting almost 100% in the last 2 years. We publicly announced that the venture can expect between $6 and $7 a gigajoule, which is really remarkable compared to where we were 2 years ago. So condensate production should be between 150 and 300 barrels per day. Our condensate is really quite light and requires less refining and could attract a premium. And I think we know that crude's just come off in the last couple of months, a 5-year high, right? So it's literally the best time to be developing a project right now. So yeah, between those 2 products, the joint venture is expecting between $50 and $75 million a year in gross cash flows per annum. What's that mean for Talon? I know I've said it before, but I'll reinforce it again. Our 45% interest means about $30 million a year in free cash flow, and that's a game changer. Okay, so to exploration upside, our third investment theme, we're in a great position, obviously, to have those reserves and contingent resources in Walyering, and that cash flow will basically allow us, to tackle the massive exploration upside we have, right? So we'll use those cash flows to convert the significant prospective resources attributed to Condor and Gravantes, and do our best to move those into contingent resources and reserves. Exploration upside. Condor, right? So this is just in the right here in the south part of the Perth Basin. As mentioned, it's the largest Jurassic wet gas structure in the Perth Basin. It has a sizable prospective resource of 408 BCF and 23 million barrels of condensate. That condensate ratio is significantly higher than what we've seen at Walyering. There we are, boom. So that's basically 5 times on a comparative level, 5 times more gas, 11 times more condensate. We've recently had the prospective resource it's been audited by risk, and we hope to announce an upgraded prospective resource once that's finalized. As a general rule in exploration, shallower equals better. Condor has been the target reservoir is much shallower, and that should mean cheaper drilling costs and better quality reservoir. So pathway to market looks really good. I mean, you can see here both the PGP and DBNGP go right through the permit. And I think that's a good cue to talk about Mongolia. Brennan obviously addressed the project in quite a lot of detail. You know, we've had 2 independent prospective resources, approximately 6 TCF. That's 2 TCF Talon to Talon, located in South Colby, you know, right on China's doorstep, you know, close to the major Chinese gas pipelines. PetroChina, of course, owning that infrastructure and taking a real interest in the project. I don't think you have to be Einstein to sort of piece those puzzles together. You know, we've had excellent success there on all 4 core holes, and we're going to drill another one here shortly. Importantly, yeah, I mean, the contingent resource will come out of the project in about a month's time, and it's looking to be the largest to come out of Mongolia. So this is the last investment theme is near-term catalysts. You know, we're going from an explorer to a high margin producer, and this transition, you know, often re-rates a company's share price, right? So for us, you know, this journey, we have a handful of significant near-term catalysts, not only across Perth Basin, but also Mongolia. In Perth, obviously Perth Basin looking to finalize the Walyering project and/or corporate debt finance, execute gas sales agreements, commence on-site construction and commissioning of Walyering, and have first revenues from the project, and perhaps look to farm out an interest in Condor. Cervantes will finalize Snow Leopard 5, get that independently certified contingent resource, again, probably the largest to date in Mongolia, and commit to stage 2 and get after the pilot well program. So in summary, we have a capital efficient business model, you know, non-operated, which is our preference. We have imminent cash flow out of Walyering, 30 million per annum, which is again almost half our market cap. We have a ton of exploration upside in Condor in the Perth Basin, and significant near-term value catalysts. You know, like you, I'm also an oil and gas investor. The energy thematic is once again held in high regard. And, you know, I continue to invest in the sector, but with a bias for one company. I think you can guess who that is. You know, Talon, you know, really has very little downside. You know, I'm very enthused by where the company's going, so much so that I've acquired enough shares in the last 6 months to be in our top 40 shareholders. And that's something I'm quite proud of. So I think the company's an ASX standout and should be an obvious choice if you guys are looking to add something to your portfolio. So thanks very much.
Well done, Colby. Thank you so much. Hey, do we have in the audience anywhere, please, a fellow by the name of Shane Anderson? Is there a Shane Anderson here? You've got about, is that his bag there? Is it really? Wait, hold on a second. Do you know what he looks like? Is this legitimate? Oh, he went out to take a phone call, did he? All right, well, then I'll keep that. I've got a bit of information for him, so I'll just keep that. So I needed to get something through to him. You'll all be thinking about that for the next 15 minutes, won't you? Right. Noble Helium is next up on the stage today. Noble Helium has 4 key projects. They're located in Tanzania. They cover a total of almost 4,000 square kilometres of premium helium acreage. Noble's aim is to diversify the helium supply chain, insulating it from the disruption and market manipulation risk that will emerge in the sourcing of this critical raw material. This happy chap here is co-founder and CEO Justyn Wood. I spoke to him ad infinitum about this particular organisation at lunchtime, and he is pretty excited and passionate about it, and I'm sure it's going to come through today. Will you please welcome Justyn Wood from Noble Helium.
Thanks very much. Thanks very much for your time this afternoon. Yes, well, I am excited about this. We've been going for more than 5 years now, and we're getting to the end game. So the usual disclaimer, no forward-looking statements, etc. But here to talk to you about helium, and I know this is an oil and gas conference, but it's actually a really natural fit. I've been 25 years in oil and gas industry, and it was an easy step sideways into the helium business. So what appeals to me is that it's an unsubstitutable critical raw material. It has a good moat around it as a product. Things like MRI machines, semiconductor manufacture, specialist welding, aerospace, fiber optics, and a host of other uses, applications of helium. Basically can't be substituted in these high-tech applications because helium has some really unique physical properties that can't be duplicated. So there's a number of, as you're aware of the periodic table, noble helium is the first noble gas, but there's a number of noble gases on that table, but helium has some unique physical properties that make it the inert gas of choice. So it has the lowest boiling point, about 3 degrees above absolute zero. So it's the smallest molecular size of an inert gas. It has the highest thermal conductivity, and importantly for semiconductor manufacturing, it has the highest ionization potential. So what that means is, if you've got an application that requires 1 or 2 of these properties in one single gas, you can maybe substitute it. But if you've got 2 or 3 where properties are required, for example, in semiconductor manufacturing, where you need an inert gas, you need the highest ionization potential, and you need highest thermal conductivity, there is no substitute. Now, 15 years ago, there was no requirement for helium in the manufacture of chips. But with the shrinkage of our mobile phones and computers and down to nanoscale sort of transistors, the helium fulfills all of those requirements in the manufacturing process. So today, helium consumes from a base of 0 15 years ago, consumes 20% of the world's helium today, and that's growing at about 11% compound annual growth rate. So by the middle of this decade, helium will be consuming, semiconductor manufacturing will be consuming 1/4 of the world's helium. So, and this is typical in the history of helium. A new technology comes along and it can't be replaced, and the consumption of it accelerates. Aerospace is another one, with Elon Musk making space commercial. The last year they launched 28 orbital launches. This year so far 33, and they're planning on 60, and then another 60 next year. And the reason they need helium is because the liquid hydrogen and oxygen in the fuel tanks for these rockets, if you used anything other than helium to purge the fuel lines, it would form ice crystals and block it. Because helium has its lowest thermal conductivity, lowest boiling point, as well as being inert, you don't want anything in a non-inert gas reacting with your rocket fuel. It can't be replaced. On the flip side, on the supply side, the helium supply chain is very fragile. There used to be a thing called the US Federal Reserve, which supplied up to 30% of the world's helium at one point. There was a massive reserve that the US federal government built up during the Cold War to provide helium basically for its rockets, for missiles. US decided to deplete that, sell it down, and it's virtually deplete now. And Russia and Qatar and Algeria have been stepping in to fill that supply gap from a number of fields. So what we're seeing is a transition away from the stability of US as a supply base for helium, and the less geopolitically stable countries like Russia and Algeria, Qatar, stepping up. Now, when we set Noble Helium up 5-6 years ago, we realized that probably wasn't a good place to be. Then the first of the Amur plants, gas processing plants, was supposed to be coming along on stream this year, supplying roughly 10-12% of the world's helium and building to sort of 30% by the middle of this decade. The gas plant blew up. Apparently, it was somebody who was smoking a cigarette, and that cut off the gas supply. So now there's no gas supply out of Russia. Well, sorry, there's no helium, but Russia then invaded Ukraine, and now nobody can get into Russia to fix the problem. So it's very fragile supply chain, and the only real solution to this is to diversify the supply chain. And we think in Tanzania we've got an opportunity to really do that in a significant way. Looking at this from a natural gas versus helium perspective, why would you invest in helium versus natural gas? Well, first of all, it's incredibly valuable, like up to 50 times the price of LNG. Okay, smaller volumes, but same cost of exploration, similar costs per MCF for producing the stuff, but a product that's 50 times more valuable. So for an investment thesis, that makes sense. Right now, liquid helium is selling at somewhere between $250 and $500 US an MCF, and spiking it up to $3,000 an MCF with the current supply shortages, thanks to Russia's what's going on in Russia. So it's yeah, as I said, similar cost base per MCF to produce it, supply it, find it and produce it, but a much bigger upside. And we're using proven technology to produce it, so we're not taking those kinds of risks. I guess rolling all this together is, in the oil and gas game, you look for a 5 TCF field so you can do an LNG train. Well, here in the helium space, a 6 BCF discovery is a company maker. So why us? So we have 4 license areas, basins in Tanzania, in East Africa, in the East African Rift system. I believe that this is one of the best untested helium systems on the planet. And it's not just me saying this. We work with Professors Ballantyne and Gluyas at Oxford and Durham Universities, the world's leading researchers on helium geology, and that's their view as well. In addition to this being the right place, my background I was with Hardman Resources. I led the exploration program, designed and led the exploration program that resulted in the first oil in the East African Rift in Uganda back in 2006. So I understand the geology very well, the stratigraphy and the architecture of rift systems. And so when we went to choose our licenses back in 2017, I knew where we needed to go. Turns out that the Rukwa Basin alone, so just one of our 4 license areas, has the potential to be the world's 3rd largest helium reserve. This is an extraordinary geological phenomenon, unique to Tanzania. And even more interestingly is that it appears to be only associated with nitrogen. So that would make it, if we prove those resources, we're looking at the world's largest primary helium reserve, and that makes a difference when 95% of the world's helium today is produced as a byproduct of natural gas. We also want to build a portfolio. So a couple of years ago, we teamed up again with John Gluyas and Chris Ballantyne, and they built us the world's first global helium atlas, looking at other areas around the world that we could potentially look at for these kinds, for large primary helium reserves. So it's done 2 things. It's identified a couple of areas that we're looking at, interested in going into, but it's also demonstrated just what a unique place Tanzania is. It's underscored what we're doing. We're on the right track. We're in the right place. So a little bit more about Noble Helium. This is an investment conference, so I know you guys need to see this. We listed on the ASX in April. Current market cap is basically where we listed. Actually, we're listed at 43 cents. We've come back down. Bit of profit taking, which is understandable, and also a bit of a rough market to land in. But we're back to basically where we started. $36 million market cap, and 8.5 million in the bank as at the end of June. And what's not on here is that if we roll this through our prospective resource base, this would give us an enterprise value, 28 million, gives us basically the P50 resource of helium in the ground would be valued at around 28 cents per MCF. This is for a product that sells for $250 to $500 US. So we're in the right place, and there's some very significant upside if we continue to kick goals. Extremely proud of the team that we pulled together, and this is all available in the public domain. But Sean Scott, who's here, is a former CEO of Arrow Energy, took Arrow from a $20 million company to a $3.5 billion takeout. Was one of the original guys in the coal seam gas space in Queensland. Brilliant member of the team. I'm really pleased to have attracted Sean to the project. I've been in this co-founded it 5 years ago. Was with Hardman, was with Chevron and others, and have pulled this together over the last 5 years. We've got Professor Andrew Garnett, who's the director of the Centre for Natural Gas at the University of Queensland, former Shell executive, ran Eastern New Ventures for Shell in the Eastern Hemisphere for a while. Really knows what he's doing. Eddie King, Craig McNabb, our co-sec, is doing a brilliant job as well. And I'll just point out Kent Masters. He's our anchor investor. Kent came in a couple of years ago. He was formerly an executive with Lindy running Africa, but Kent these days is the chairman, CEO, and president of Albemarle, the world's largest lithium mining company. So he loves helium, loves what we're doing, and he's well and truly in the seat. These are our license areas. We've got the North Rukwa, North Nyasa, Ayasi, and Manyara. These licenses have been awarded. These are about to be awarded. And I'll just point out a couple of key things. So this is nearly 4,000 kilometers of acreage on what we think is probably the best helium geology on the planet. We've got just south of our licenses, there's a blacktop road all the way to Dar es Salaam that the Chinese graciously built for us. And we've got the reason behind the geology is we've got this Tanzanian craton, and it's being rifted uniquely. Like there's nowhere else on the planet that this is happening. Thank you. Right. So I'll just skip through quickly. Very strong community relations and very strong relations in Tanzania with the government. That's extremely important. This is a project of national interest to them. These are our license areas in North Rukwa, our flagship project. Long story short, there was some vintage data that we've used to get Netherlands Sewell to give us an independently certified resource of 176 BCF mean of helium, if we're correct. And remember, 6 BCF is a company maker. The helium concentrations here are enormous. There's up to 10%. There's a 10% hot spring helium in a hot spring just here. And it's only associated with nitrogen. Now, what I really want to talk about is this is the basin margin fault closure play that we actually opened the East African Rift system with back in 2006. There's been 14 on the left-hand side, 14 of these closures have been drilled and 14 discoveries in oil and gas. It's a very effective seal. On the right-hand side, there's a less effective seal where you've got intrabasinal fault-related trapping mechanisms. We're focusing 100% or mostly on the left-hand side model, and I'll just give you a quick run through of what we've achieved so far since listing. So these are our licenses. We've acquired soil gas surveys with the University of Dar es Salaam over almost all of our area. There's a little bit to go. We've also just finished acquiring airborne gravity gradiometry, and that's confirmed where our structures are, and we're finding that the structures and the soil anomalies are coincident. So I'm just going to run you through quickly, flash it up.
Why do it quickly? Why don't you entice them out there to hear about it and get everyone that's watching online to ring you?
Okay.
Leave them wanting more.
This will be 30 seconds. Can we just finish this? All right. So the soil gas surveys are coincident with our structures. This is the early AGG results, confirming that our structures really are there. And I'll just zoom you in where we're about to acquire 3D seismic. This is the basin margin fault closure. And the soil gas anomalies appear to be coincident with structure. And the thesis is we've got helium trapped under the ground. So we're looking forward to testing that next year. Okay, I've got to go.
Good idea, Justyn. I knew you were excited about it, and there's good reason too. And we can all come have a chat with you later. You have to leave the clicker too. Some of you fellas get so excited you want to take the clicker. Did Shane Anderson end up coming back into the room? Where are you, Shane? Shane Anderson. Well, stand up. We'd all like to look at you. Yeah, we'd love to have a look at you. Shane, do you have a special someone in your life at the moment? You don't. Single. She's looking even more attractive, isn't he? And he's going to look even more attractive with a $750 Crown voucher because you're the fellow that sputtered the well. There you go. So he's single, he's here by himself, he's got no mates, he needs someone to spend $750 with the crowd. But if you go out and see the team at Gallagher, they will give you that voucher. How many people had a go at it? Did you all have a go? Yeah, Shane, we're not real keen on you. All right, we've got a couple of presentations left. That's a nice end for you for the session. And the next one is Triangle. Our next presenter is Conrad. Todd, he's the MD of Triangle. Triangle, of course, are a small to mid-size oil producer with oil and gas exploration and a foot in the carbon recapturing realm. And that's our focus for the next 15 minutes. But while he's up here, and how about you talk about it afterwards? I'll get some time out of you. How about a look at that pin that's on his jacket up there? That pin is something pretty special, which involved supersonic travel to Western Australia from the place where he comes from. But we do make him welcome for this point in time to talk about Triangle.
Thank you very much. The standard disclaimer, I won't read it out because we'll be here all day. Let's talk about Triangle. I'll give you a quick run through. This might be a bit of a gallop through Triangle Energy. We've got a 1.3 billion shares on issue. Share price is 1.3 cents, a market cap of about 17 million. We've got a lot of options out there, 800 million. And interestingly, an EV of -3 million. And I won't go into that now, but if anyone wants to buttonhole me afterwards, I'm happy to discuss that. Cash in the bank of 6 million as of the end of August. And rather interestingly, $13 million worth of state gas shares. They're a Queensland coal seam methane company. We produce from the Cliffhead oil field, we produce just under 700 barrels of oil per day, gross, in which we have a 78.75 interest. We have 2 more blocks onshore, L7 and EP437. We have 50% of L7, 13% of EP437. We'll very soon have 100% in each one. And 45% in this little strip, TP15. So everyone wants to know, cut to the chase, how's it going to grow? Well, firstly, let's say production's steady. It'll increase after we complete the Cliffhead 10 workover. That's going to be sometime in October. The big question for us was, can we carry on producing Cliffhead oil? And yes, we can. We've just delivered 51,000 barrels to Thailand, dropped it off at a refinery in Bangkok. What's going to happen to Cliffhead when it comes to the end of its economic life? We're joined with Pilot through the Cliffhead joint venture. We're looking at converting the Cliffhead to a carbon sequestration project at the end of its economic production. We'll change our interests. We'll go from 80% to 40%. Our JV partner will come up. And then finally, where are we going? Back we go. These 2 onshore blocks. Northern end of the Perth Basin, really lovely blocks. We've just upgraded the resources to 600 BCF of gas, and these are prospective resources and 19 million barrels of oil. We like it so much, we've just shot 3D seismic. That was acquired in May. It's in Canada to be processed. It's coming in Q4 this year, and we expect to be drilling in 2024. Now, that's a conservative promise. I like to promise low, and if I can over-deliver, it would be really nice if we could drill at the end of 23. Cliffhead oil field. This is producing quite nicely, doing about 700 barrels of oil per day. we pipe it onshore to the Arrowsmith plant. Cliffhead oil field is located in the federal waters, and that's really important. I'll come back to that later. We're working over the Cliffhead 10 well, which is that one there. We're replacing the downhole pump. That's going to add about 100 barrels of oil per day. And we have potential to drill 2 further wells, the Western development and a near-field exploration well called Mentel. We need some finance for that, so that's subject to farm out or financing. Cliffhead oil. There was a big question whether we could actually manage to monetize our production out of Cliffhead. As you recall, our export route through Geraldton shut down. Our last export there was April. We've come up with an alternate route. And the alternate route is, it's a little bit complex. We've refurbished those 2 of the 3 tanks. We can now store 30,000 barrels of oil. So we produce, we fill the tanks up. We have a chartered tanker, comes into Geraldton. We do a 4-day, 24-hour-per-day truck run, half fill the tanker. Tanker goes, anchors offshore, carry on producing, fill the tanks up. 24-hour truck run, tankers in Geraldton, fill it up again, and it goes off, sells our oil up in Asia. We've got the first one away. The tanker's offloaded the oil. It's bunkered up with fuel in Singapore. It's on its way back. This is a short-term fix. It's going to last us about 18 months. But for the next 18 months, we've got the only oil export route out of the Perth Basin. And that means we're talking to people, they're coming to us, and the more oil we can put through this, we reduce our cost per barrel. Cliffhead Carbon Capture Project. Brad's talked about this in great detail. So I'll just say, at the end of economic life, we have $350 million worth of kit on the seafloor as a platform, as well as and the processing facility. Generally, what would happen is you rip it all out and you throw it away. And that's kind of a waste because it's still in really good condition. And we could think of something to do with it. And in fact, what we would do is we would reverse the flow. So we have the onshore facilities and they're in WA. At present, there is no legislation to sequester carbon dioxide onshore WA. This field sits in federal waters. We can do it. We can sequester in federal waters. We have a 14K pipeline joining the two. So it's a very doable project. And we're going to save a lot of money compared to other projects because we've already got the infrastructure in place. So it looks like the 2C resources are about 6.5 million tons of CO2. The economics suggest it's profitable. It's a good thing to do. It is a good thing to do. You're sequestering carbon dioxide, and it's going to make us a bit of income. So it's doubly good. Let's get to the excitement. The excitement is these 2 blocks here, EP437, L7, northern part of the Perth Basin. We're going to get 100% interest in both of them. They're within walking distance of Waitsia, Lockyer Deep. Waitsia and Lockyer Deep are probably going to pan out to be about a TCF each. And they contain the Mount Horner oil field, produced 1.8 million barrels. So I'd say that the oil migration into the blocks are given. The Y1 well over here tested gas. Gas migration into the block works. So there's good potential for significant gas and oil discoveries. We calculate 617 BCF of gas, best estimate prospective resources in 5 prospects. The largest one is the Booth prospect here, and 19 million barrels of oil in 7 prospects and leads. As I said, we've shot the 3D, it's being processed, we're looking to drill. I'm a geologist, we always have to have some sections. This runs from east to west, and you see you're coming out of the basin, and we're getting our prospects, the gas prospects are in the King Ear High Cliff, Same reservoirs as the big gas fields in the Northern Perth Basin. They're downfault sealed, same as Waitsea Lockyer Deep. And we have Booth, Mount Horner Deep, and the Mountain Bridge South. On top of that, we have oil in the Jurassic and Mount Horner oil field. Is that a 3? Was that a 3? Okay, we're moving. And an example is the Mount Horner deep well. It'll go through shallow oil, gas or oil in the Dongara and Irwin River, and gas in the gas prospect in the King Eyre High Cliff. I've shown you those, I'll spin through. Key points: production. We are producing, we're exporting, we're making money, continuity of production at Cliffhead. Exploration looks attractive. Farm outs, we have a farm out for the L7 block underway at the moment. And we're looking hard, we need to get more new ventures in. Transition, we're transitioning to Cliffhead at the end of its life. Rather than waste the infrastructure, rip it all out, we'll transition it over to a carbon capture and sequestration project. And we can get it to work. It's the only one that's going to get away in the next couple of years. We have new management. We're very focused. We're focused on the high value oil and gas exploration onshore, and we'd really like to transition Cliffhead. Everyone wants to know when these catalysts are going to happen. We've loaded the first tanker loadout. We've loaded the second tanker loadout. We've delivered our oil to Thailand. Tanker's coming back, and it's a rinse and repeat. You know, it's a lot of work, but it's very doable, and it makes us money. Cliffhead 10 workovers underway. That'll finalize next quarter, and it's going to add production. We'll finalize the 3D seismic interpretation and reissue firm resources, and then we'll complete the farm out of L7 early next year. The big one is going to be drill gas and oil wells in L7. In success, that's going to give us a real high value. You can see by the looks of Norwest, people like that. We expect that to happen in Q1. We'd like it to happen a little bit earlier. It's all about the regulations, the regulatory authorities, and getting those through. In the meanwhile, we're progressing the carbon capture project with pilot. That's underway. We expect to get the first milestone over the line early next year, and mid to late next year, we'll get the final authority to go ahead. I heard all the dings from out there. I've rushed through a little bit. It's a bit of a gallop, but I'd say we have an exciting future, but I would do, of course, with a rejuvenated team. We're aiming to come up with a balanced, mid-sized oil and gas company with a firm foot on the carbon capture project. So we'll have a CCS side. Our management team has got an awful lot of experience in E&P, in the oil and gas space, and we have commercial acumen sitting in there. We formulated a new plan. We're putting it in place. Production's steady. We're actually exporting. We're making money on it. We're looking to transition. At the end of economic life, we'll transition to a carbon capture project. And we're focused on high value onshore North Perth Basin exploration. We've done this in 6 months. We think all of those measures are going to add value. So we've got it lined up, and we're going down the road, plans in place, and we're off. Thank you very much.
Now, stay there because the microphone won't come across, and those of us who are listening and playing along at home will have heard me talk about the pin that you're wearing, and they might be interested too. So it's a little gold, for those of you at the back, it's an actual gold kangaroo. It's not been given to him from a gift shop or anywhere else. It's actually pretty important. It was presented to your father-in-law at the Royal Perth Yacht Club. Tell us why I got it.
My father-in-law was the medical officer in the RAF on the first non-stop supersonic flight from the UK to Australia. It flew from Brize Norton to Perth in about 1962, 3 Vulcans, 3 V-bombers, beautiful planes. They in-flight refueled about 5 times to get over here in one go. It must have been great to see. Unfortunately, I was only 2 at the time too. And I haven't seen the pictures either.
It's amazing. And I did ask him why he ended up with the pin, and he said because he was the favourite son-in-law. He's, of course, the only son-in-law.
I am the only
well.
son-in-law.
But it's a great story. It's a really good story. So I just thought it'd be worthwhile sharing, and you can have a chat about that with him, as well as the great opportunities that he has to offer you. Conrad, thanks so much for coming up today.
Thank you very much, Chrissy.
Cheers. Mr. Thomson Naude, Chief Financial Officer, Carnarvon Energy. Would you please join us, sir? Fantastic. So Carnarvon is an oil and gas company focused on the northwest shelf of Australia. The company's main assets include their share in the 150 million barrel Dorado oil field and the recent Pavo Discovery. Thomson is Carnarvon's Chief Financial Officer, as I mentioned, and he's going to provide us with an update on their most recent developments. Please make him very welcome.
Thank you, everyone. We're on the home stretch, so here we go. So Carnarvon Energy Ltd is a Northwest Shelf focused oil and gas company. Our primary assets are along the Northwest Shelf. Today I'll be focusing my presentation on the Bedout Sub-Basin, the wondrous geology that is the Bedout Sub-Basin. We do have assets elsewhere up north there, and or the Pepper Project south of Dorado. We also have a renewable diesel project, but unfortunately, given time constraints, I won't touch on that today. But we do have discovered resources in Dorado and Pavo, a combined resource of 200 million barrels of oil discovered. As well as that, we've got a plethora of exploration opportunities with over 100 prospects in the Bedout Sub-Basin. Just touching on our share price performance recently, you know, we all had a pretty tough time in this industry during COVID when oil prices technically were negative. As things strengthened, Carnarvon did discover the Dorado field prior to the COVID-19 pandemic. And following the pandemic, as oil prices normalized, our prevailing share price is around that 35 cents per share. We then drilled the Buffalo well, which disappointed. So the share price reacted accordingly. Following that, we drilled the pretty exciting Pavo well. It was successful. That well found just short of 50 million barrels of oil, taking the joint venture's total to that 200 million barrels of discovered oil. For Carnarvon, that was a 37% increase in resource. So effectively, we increased our resource size by 37%, but we're trading at the same share price as prior. We then went to drill the Apis well, and unfortunately, that did not encounter a commercial level of hydrocarbons, and we've traded the wrong way since then. Carnarvon's enterprise value is $200 million, given our market capitalization of $300 million and just over $100 million in cash. So if you take our enterprise value of $200 million and Carnarvon's discovered oil resource of 45 million barrels, you can today effectively buy our oil for US $3 a barrel. Given oil selling for about $100 a barrel now, that's probably not bad going. So touching on the investment snapshot in Carnarvon, world-class assets. I mean, a lot of people say this, but I'll remind everyone that when we discovered Dorado in 2018, it won the Wood Mackenzie Discovery of the Year. That was a worldwide discovery award. So this was recognized on a global scale by Woodmac. Low cost, shallow. Dorado is located in really shallow water, less than 100 meters. So it's a simple development. It's near services. Santos put out some guidance on cost prior, and we're looking at a range of CapEx range of about $15 to $20 a barrel to develop this field. And OPEX is lower, less than $5 a barrel when this thing's producing at full capacity. We're in a tier 1 location here. We're in our backyard in Australia, offshore, in a proven hydrocarbon system. It's operated by Santos, very experienced offshore Australia and onshore Australia, one of the most experienced operators, and they've run a lot of similar projects to Dorado and Pavo. Dorado is going to produce an incredible amount of cash flow when it's online, and I'll take you through that a bit later today. And even with the success and over 200 million barrels of discovered resource, we have over 100 leads and prospects in this basin. So there's a lot more to come. Just recapping on what happened at the Dorado discovery. Initially, we were targeting a gas field following the rock success we had in the basin prior to that. So 2018, we start drilling. There's 4 targets, each with their own risk. Sorry. The first one was the Caley, which is the main oil reservoir that we've got. That was successful. We were all really happy. Oil, even better than gas. Next comes the Baxter, which is that thin sand of gas. While all we've intersected on Dorado 1, 2, and 3 is gas, we have a bit of a gut feeling as you go deeper. We think it could be an oil leg down there. Crespin is a smaller gas resource tagged by Dorado 1 and Dorado 2, I think it was, or Dorado 3, one of the 2 appraisal wells. And then deeper, we have a really clean sand in the Milne, gas in a couple of wells, but then as we saw in the other resources, getting oilier as we go down dip. A really fantastic result. We came in at 4 from 4. Like most resources in the offshore Northwest Shelf, it's going to flow like the clappers. And you can see here on our flow testing results here from Dorado 3, the Caley flow test flowed at 11,000 barrels a day, and a lot of flow tests have constraints due to the equipment we use. Speaking to the engineers at Santos and Carnarvon, what we're looking at, what a production well can do in this area is about 30,000 barrels of oil per day. So highly prolific. What's the Dorado development going to look like? It's actually quite a simple meat and potatoes type of development. As you can see by this image here, very simple unmanned wellhead platform. It's been designed with 16 slots. The initial development will have 10 wells drilled. That gives us flexibility to later on come back and start drilling out, down dip oil columns and increase production later stage. So the FPSO has been designed to allow that flexibility to enhance production in the later stages of the field life. FPSOs capable of producing 100,000 barrels a day will be re-injecting all of the gas. So there's no unnecessary venting or flaring of the gas in the resource. We'll be re-injecting that back into the reservoir for production later in life. What you can see on the bottom of the screen is what looks like a fairly standard oil decline curve or production decline curve for a project like this. And I touched on earlier on the relatively cheap development costs. In our engineering and scoping work, Santos actually put out some guidance. We were looking at a development in the order of about from $2 billion to $2.2 billion US development costs, right? For a project like this, it pays back in year 1. So all of that is cream after project CapEx payback. And as I touched on before, we're looking at an operational cost of less than $5 a barrel when we're at these sorts of rates here. So the cash flow generation on this asset is incredibly strong. We've done substantially most of the front-end engineering and design on this project. There's 3 key steps remaining. The first is the offshore project proposal that is being assessed by NOPSEMA. That's the key environmental approvals. They're significantly advanced. We're in last discussions with NOPSEMA at the moment. There's only really 2 outstanding matters. Sorry, there's only 2 outstanding matters. We're pretty confident we'll resolve those throughout the rest of this year, and then we're on from a permitting perspective. This field already has a production license in place, so all that's well placed. We made an announcement about 2 weeks ago. A key issue we've got at the moment is supply chain, which is no surprise to any sort of operation that's going on. We had that cost estimate of between 2 and 2.2 billion US dollars to develop this. It's looking a bit higher than that at the moment. It's leaving us a little bit uncomfortable. A key for us when we're building this, particularly the FPSO, is we want to achieve construction on a lump sum basis. So contractors are having difficulties delivering things like FPSOs on a lump sum basis, but we are working on it, and we are starting to see things normalize. Steel costs have come down. Labor is moving more freely through Southeast Asia, where this will be built. We're expecting the FPSO will be built in Singapore, and things are getting back to normal there now. So we hope in the new year to get more confidence on that supply chain and start getting to FID on this. Finally, what that does do while we wait for supply chain to normalize, we are looking at the integration of the Pavo resource, which I'll take you through in a moment. Moving to the Pavo Discovery, that's the discovery I flagged this year, where we increased our resource by 37% for Carnarvon. It was an excellent result. It went about as well as we could have hoped for. As you can see, it's a structure that's divided into two. This one's for the geologists, but given I'm not a geologist, I'll talk about the cartoon. Pavo 1 intersected the northern part of the structure there. What we had is we've confirmed 43 million barrels of oil. This oil can be brought simply into the Pavo infrastructure, so it's going to extend that field life for the Dorado facilities. What we did find at the bottom or towards here in the Pavo 1 well, there's a residual oil column that's below the saddle here that separates Pavo North and Pavo South. Pavo South has an additional resource of another 50 million barrels. We will come test that in due time. What that will mean, if successful, that'll take our resource size to 250 million barrels of oil. So really more than enough to have to deal with in our development. So what does the integrated oil development look like? We've got Dorado, which we spoke about. That's the 150 odd million barrel development. Pavo North simply gets tied back via a subsea pipeline, brings out total development to 200 million barrels. We drill Pavo South, we've got 250 million barrels. What's really important is we talked about our production decline curve there for Dorado and how Pavo South works like that. Well, you saw it does decline quite fast in Dorado. So what happens now? We've got space in about year 2 or 3. The Pavo oil can work together with what we have at Dorado. So what we're going to do is ensure the Dorado FPSO is spec'd to take the Pavo liquids in from up front. It doesn't have to go back to any yards. We can have it ready to go from the get-go. And then about year 2 or 3, we'll drill a couple of extra wells in Pavo North and tie that back. As I said earlier, we're expecting project payback in year 1, and you're keeping those production rates maxing out at that 100,000 barrels a day. It's pretty easy profit to be making, super attractive returns. Bring Pavo South in, that just keeps going. And remember I said, once we've had capital payback there, we're producing at $5 a barrel here. So at $100, $90 a barrel, it's a lot of profit for the venture. Moving on to the exploration potential. As you can see, Dorado development will be here, Pavo's to the east. There's a couple of areas that we will be focusing on from an exploration perspective. What we had at Pavo, great result. It's proved up the regional seal in this area here. So all of these prospects are super attractive and they'll keep that Dorado facility full for a very long time. As long as the world needs oil, we'll have oil for it. To the north, there's some massive prospects here, Ara and Bandy. It gets gassy to the west here. And there's a number of oil prospects here and leads here to the east. We've recently acquired 3D seismic over that area to the east. We are, in fact, working on our top 10 to 20 prospects in this basin, and I'm glad to say we'll be providing the market with an update on those resources in the coming month or 2. It's going to be pretty exciting. Quickly touching on our funding process, as we are looking to make final investment decision on Dorado as soon as we can, once we've cleared the OPP and sorted out the supply chain issues. Firstly, we have commenced a senior debt process. It's well underway. In fact, I was pretty encouraged by the level of support we've received for that senior debt process. I think, it's fair to say that the events in the Ukraine and Russia have sharpened particularly international lenders' focus on ensuring we have plenty of energy security in the region. So really strong support from around the world, but particularly European banks, which is great. We are looking at other sources of financing, mezzanine finance, and that includes talking to traders. They're pretty hungry for this oil. It's quite a useful product, really high paraffinic naphtha cut. So it's in quite strong demand, and we're pretty confident. In fact, we've got a report from Wood Mackenzie saying we're pretty confident it'll be selling at a premium to Brent. So the traders want to get their hands on it. And there's various other funding sources we're looking at, such as royalties. We are also running a divestment process on this. Just to give you the raw numbers, Carnarvon's share of that $2 billion capex, theoretically it's $2 billion, it's a $400 million US proposition for us. If we sell, say, a quarter of our holdings, our funding ask is down to $300 million, but we've brought, for example, $100 million in to fund that equity gap, and the debt does the rest. So that's our plans there on that. Quickly summing up, we've got a lot of discovered oil. In this region, our finding cost has been less than $2 a barrel. You can buy the stock now equivalent for $3 US a barrel. We've got over 100 prospects and leads to chase in this area. We've proven success here. There's several lookalikes to Pavo and plenty of other exploration upside and up in the north. A funding process is underway. It's really encouraging. We're expecting to have a good, strong level of senior debt support and potentially a divestment to go with that as well. Thank you.
Well done, Thomson. Impressive ends there. We've got 2 more speakers to go. And this next one, our second last presentation at RIU, is they're bucking the trend because they're actually giving back to their investors, and they have been for the last couple of years. Horizon is a low-cost oil producer, highly leveraged to the oil price and generating strong cash flows from a portfolio of assets across the Asia-Pacific. And having recently commissioned a significant new field development, the company has materially increased production with further growth plans to follow. Horizon is committed to optimising production from its portfolio with a focus on you, their shareholders. Would you please welcome Richard Beament, the group's CEO?
Well, look, thank you very much. Look, I'd like to think that we might have saved the best till, well, almost last. Look, you've heard a lot over the past few days of companies with aspirations to discover, develop and fund new oil field developments with the hope that one day investors might just receive a return and hopefully some dividends or distributions. Well, at Horizon, we're just not living a dream. It's actually a reality. Here's a company generating strong cash flow from its assets. Importantly, still investing in its portfolio, but most importantly, delivering significant returns and surplus cash back to shareholders. So let me take you through the story. And whilst before I do that, please note that everything I mention here is generally US dollars, so real dollars, unless otherwise stated. So we've got our usual compliance statement and disclaimer, which I'd encourage you all to read. So on to who we are. Well, look, Chrissy's already mentioned, we're a low-cost oil producer. We've got 2 core assets, the Maari field offshore New Zealand, where we have a 26% non-operating interest, and Block 2212 in China, where we have a 27% or just under 27% non-operated working interest. The 2 fields combined are generating about 5,000 barrels of oil per day net to Horizon, which is about a 40% uplift on the FY22 average. And we're throwing off significant cash flow. So net cash at FY22 year end was just over $40 million US dollars. And as Chrissy mentioned, we've got a history of returns to shareholders, and that's core to our strategy. So our strategy is pretty simple. First of all, we aim to maximize cash flow generation from our existing assets. We're focused on shareholder returns and making further distributions when it makes sense. And we'll continue to invest in production growth, focused firmly in and around our existing assets, but keeping an eye out for any exceptional new business opportunities. And most importantly, we're delivering on this strategy. So in FY22, we generated significant cash flow, with EBITDAX of over 73 million US dollars, or over 100 million Aussie dollars. Our ability to generate such significant cash flow is really underpinned by a very low operating cost, under 20 US dollars a barrel. It's that sustained free cash flow generation which has enabled us to return significant amounts of capital back to shareholders. We delivered over 70 million US dollars, over 100 million Aussie dollars in distributions during this year and announced for this current financial year. That's 3 Australian cents per share for 2 consecutive years running, and represents about 40% of the company's current market cap. So that's a roughly 20% distribution yield per annum for the last 2 years. And notwithstanding these distributions, we're still investing in production. We brought online during the year our first big new oil field development in about 8 years, with the 12-8 East oil field in China. This field has added significantly to our production, and I'll talk about that a little bit later. But we're not stopping there. We're continuing to invest in production growth, and in fact, we've got some wells which are being drilled as we speak. As I mentioned, all of this has led to some great success in production growth, and we're currently producing more than 40% higher production levels than we were for the FY22 average. Now, in terms of Horizon as a snapshot, here's a bit of a story on our share price history. You can see pretty clearly, you've got the oil price in the green, Horizon share price in the orange, and the ASX 200 Energy Index in the grey. You can very clearly see the linkage and leverage to the oil price, but importantly, we're outperforming both the ASX 200 Energy Index as well as the oil price. And that's really underpinned by that strong free cash flow generation and the returns we're delivering to shareholders. I won't go through the detail of this slide, but here's really a snapshot of all the key highlights from FY22. We had significantly stronger financial results with a 70% increase in revenues, 100% increase in EBITDAX, 200% increase in net profit after tax. And all of this drove significant cash flow generation, enabling us to return money to shareholders. We also were able to extend our existing debt facilities with our senior lenders ANZ, Westpac and ICBC, again showing the quality of the assets in what is a more challenged financing market for the sector. Operationally, I've mentioned the successful completion of the 12-8 East project. Impressively, first oil from this project was delivered within 18 months of FID, notwithstanding the pandemic and the various global supply chain challenges. On ESG, despite the elevated activity levels, we're operating very, very well, and we're significantly better than industry benchmarks. And on climate change, we declared our ambition to reach net zero by 2050, and we're developing a roadmap to achieve this. So now turning to the assets, starting with Block 2212 in China. Our production comes from 25 wells spread across the fields here. Historically, production's been concentrated in and around the 612 and 12-8 West fields, where we've had production over the past sort of decade of around about 8,000 to 10,000 barrels of oil per day. And that production's been largely sustained through various initiatives, infill drilling and so on, in order to sustain production levels. During this year, we brought online the 12-8 East field, which is here in the bottom right, and that's really transformed the field. So production rates have lifted from that 8,000 to 10,000 barrel average up to over 15,000 barrels a day gross over the last month. That's really a game changer for us in terms of free cash flow generation, and we're not stopping there. In recent years, these fields have generated around 70% of our cash flow, owing heavily to the very, very low operating costs, which are less than $13 a barrel. So a little bit more on the 12-8 East development. Here we've got a 3D graphic really showing the core elements of the development. We've got 6 producing wells into the various reservoirs and 1 water disposal well. And the development includes a leased self-installing wellhead platform, which is tied back to the existing infrastructure, the 12-8 West platform. As mentioned, we brought on the project in April this year, with Horizon's share of development costs on time and in line with the original budget of around $20 million. Following cleanup flow, these fields have contributed around 9,000 barrels of oil per day gross throughout the last month. And we expect that's going to decline down to an average for the first full year of around 4,000 barrels of oil per day. We're highly encouraged by the initial production results, and should we continue to see the continued strong production performance, we'll likely look to further development of what is quite a large resource. Now, this map shows the various additional infill exploration opportunities in and around the block. And so again, you've got all of these 3 sort of production hubs, and you can see the smattering of multiple additional opportunities, which are in easy tieback reach to our existing facilities. Importantly, I mentioned we're starting to drill additional wells already, and we've started with the M3 well, which is currently drilling ahead, and it'll be followed by the North well. As part of this sort of expansion program. We've also conducted a multi-well workover program, which has just been successfully completed. Again, helping us to sustain these strong production levels. Now looking to the sort of our outlook on the asset and a bit of history, this sort of shows, you know, the sustained production levels we've been able to achieve over the past almost decade. And the green section here is really our existing 2P reserves profile from the asset. This blue section is really the additional production potential to be unlocked by developing our contingent resources and prospective resources in the block. Importantly, the 12-8 East development has really initiated this kick up in production. And as I mentioned, we've got infill drilling underway, which will help us to sustain and continue to unlock this value. But this is really where the potential lies in the block. Looking at our other asset, the Murray asset continues to be a strong asset for the group, generating about 30% of our cash flow. Importantly, the production decline rate here has been heavily arrested by continued water injection into the field. And production rates here are largely sustained without the need for significant CapEx spend. On operating costs, again, it's fairly low or modest in the context of the current oil price. And Murray crude attracts very high premiums to Brent. We've got some planned workovers here. We're impacted by COVID, but we're getting onto them now, and we expect production rates to lift over the coming months. Similar to the chart I showed you on our China asset, this one also shows the production history. And importantly, you can see this is really the future. You can see that the production levels are heavily sustained without really that big decline rate, again, driven by the water injection into the field. Our focus is to produce at least out to the end of the permit life, with the option to extend being actively investigated. And there's further contingent resources we're looking at potentially unlocking through infill drilling over the coming years. So in summary, look, Horizon's had another very strong year in delivering significant value to shareholders, and the outlook looks pretty rosy. We commenced FY23 with very, very strong production rates, which again bodes well for strong cash flow generation. As I mentioned, we've got current daily production at over 5,000 barrels of oil per day, up by 40% on FY22, which was already a very strong year. To sort of put things into context, we're generating about $500,000 daily in revenues, and that's up from about $300,000 a day in 2022 or FY22. Now, whilst we don't expect to sustain these production rates from the current well stock, initiatives such as the infill drilling I've mentioned are really all about trying to sustain those production levels and bring on additional production growth. We're determined to continue to deliver value to shareholders, having returned almost 50 million Aussie dollars last year, and again, another $50 million in returns this year. In terms of new business, our focus is on our existing assets and unlocking the remaining value, but we do keep an active watch on new business opportunities, but they've got to be a compelling proposition where we can continue to look to provide further distributions to shareholders. Whilst everything's not easy in the sector, we've got ESG pressures, supply chain challenges. We've got a very talented team, and we look forward to continuing to develop and unlock shareholder value. Thank you.
Well done. Great end. Thank you so much, sir, for winding us up there with our investment potential and possibility. Now, while you're all still in the room, if you would like to remain in the room until the end of the day, we're going to be setting up outside for tomorrow's conference. So we need to change all this up. But what I would love to invite you all to do is to come out to the hotel bar, because someone has obviously made some money today and he's put some money on the bar for us all. So it's on the hotel bar. Stewie's made some money. Not blooming telling me what, but I've had a look through. I've got Connecticut up 6.75 since they presented at 10 a.m. TMK's up 10%, Empire Energy up 4%. So I don't know what he invested in, but I'm glad because he's put some money on the bar for us, and that's the important thing. We'd even have a cup of tea if you just like a cup of tea. Right, our last speaker. for the day, was also in a way our first speaker. He took to the stage at the start of session 1 to welcome you all and steer the ship until I joined you. Peter Strachan made some very sage observations at that point about population growth and the increased appetite for energy, which of course go hand in hand, emissions from fossil fuels. Now, this mild-mannered fellow up here started his working career as a metallurgist. He is now an analyst for the aptly named Strachan Corporate. He's sat, he's watched, he's listened, he's analysed over the course of the conference, which is something that he does every day because he is interested. So does he have a take on what a realistic view of our energy future looks like, given everything that's happened since we had our last conference back in 2021? Well, he's put together his own presentation for us. It's called Skating on Thin Ice to close off RIU Good Oil and Gas 2022. Would you please make welcome Peter to the microphone?
Thank you. Thank you. Look, yeah, it's been 12 months, and what are 12 months? Who would have predicted the oil price would go from $60, $70 a barrel to over 120 and back to 93 today? The Henry Hub gas price was $4.30 a gigajoule, went up to $9, it's about $8 and something today. I was talking about Woodside then, and saying that I thought that the deal with BHP Petroleum was pretty good. The share price was about $19.50. It's been up to over 35. I think it's about 34 today. And the coal price was like coking coal, thermal coal was $170 a tonne, and it's been up around $400, sort of $360 a tonne recently. LNG into Asia, about $18.60, and I think spot price is about $55 into Asia at the moment. And of course, the Dutch European gas prices were about $13 a gigajoule this time last year. And as we've heard here, about $50, $60 a gigajoule. I think we did see spot prices about 93 recently as well. So it's been a hell of a year. And so I've decided to call the talk, Skating on Thin Ice, because I think in this globalized world, with COVID, with Putin, with demand for resources and population growth of 80 million people per annum, I think we are skating on thin ice. And I mean, in Australia, our energy demand since 1979, our energy consumption has doubled. We've added about 12 million people to the population of Australia in that period, and we'll hit 26 million people in the next month or so. So even though the population has risen by 75%, because of increasing affluence and increasing activity in the economy, that means that our emissions from all of that fossil fuel consumption have also doubled. So we'll start with what's important is, where should we invest in this environment over the next couple of years? We've got rising interest rates, but, if you look back over history, you can see that stock markets often rise when interest rates are rising. And usually it's the last kick of the interest rates that knocks the market down. It happened in 87. The markets were rising, interest rates were rising through 84, 85, 86. It was only that last interest rate rise that knocked the market back in October 87. Some markets are very high. I mean, if you weren't invested heavily in the United States, there was a really good chart out of Platinum Asset Management that showed that basically any fund around the world, any investment fund that wasn't heavily invested in the NASDAQ has underperformed. The broad fund, others sectoral have done okay. But really the impacts have been on commodities that we've seen recently with COVID restricting activity as more and more, you've always got 10 or 15% of your workforce actually isolating because they're sick. And then more recently, of course, Putin's war in February, there were the drums of war earlier on in 2021. And then Putin's war has really caused the oil prices and gas prices in Europe, as we've heard from a number of players here today. And really, as I said last year as well, holding cash is always a smart move, because what we're seeing now is companies coming back. We're doing shareholder purchase plans. Some of those can be very attractive. I remember during the global financial crisis, Wesfarmers did a shareholders purchase plan at $13. And, you know, if you had the cash, you took it up, now they're $55 or whatever, and you've probably got your $13 back in dividends since. Yeah, as interest rates rise, then I think there will be bargains presenting themselves. The other thing what I was saying last year as well is to reduce your exposure to small cap stocks. I mean, in a market that is risk averse, where it's more and more difficult to fund yourself by just going back to the market and raising money, the small cap stocks will have difficulty. I mean, if you're in the lithium market, or if you're in rare earths, or if you're an oil and gas company that actually has got a whiz-bang project, like a company like ADX or some of the others that we've heard over the last couple of days, then you will be able to raise money. But a lot of companies are going to find, unless they've got some sort of company making activity, you're going to find it difficult. Companies in the hard rock area as well. And energy and base metal stocks remain favourable through this difficult period, especially, as I mentioned, the lithium metals, lithium, copper, nickel, graphite, graphene. And of course, we've seen the corporate activity starting to happen here as well, with Hastings and the Wilo investment, BHP making a bid for Oz Minerals. And, you know, basically the value funds managers have really underperformed, but I think their time has now arrived. And if we look back at where we were last year with BHP and Woodside deal, shows you on the spot Asian LNG, how much that's moved up. With Brent, we were, you know, the deal was done, was sort of hatched at sort of $60, and now we're, you know, just over 90. And spot European gas has been $93 a gigajoule, as I said. And energy prices basically are skyrocketing, with coking coal going ballistic. In fact, some of the coking coal producers are now selling their coal into the thermal market, because the thermal gas price, which is normally at a premium to the thermal market, is actually now offering better value for coking coal. And, you know, this is going to be a really difficult winter in Europe. People are really scared about what's going to happen. Putin's basically turned the spigot off. I think he's going to try and freeze Europe into submission over this winter, so that people will be so cold and so miserable that they'll be suing for some sort of a treaty, if not peace, but some sort of a treaty. And Putin's already got his operative out in West Europe, Western Europe, in social media. He's got his people on the ground. You know, people who don't agree with him find themselves flying out of the 5th floor of a hospital unexpectedly. So, you know, it's going to get pretty nasty, I think. And of course, liquefied natural gas to the fore, because in fact, liquefied natural gas coming across the Atlantic is basically taken over from Putin's gas. And this is where we left off last year with, as I said, Woodside was around about that, just below $20, and it's traded as high as 36 this year. And I did put some numbers out on that last year. And this is basically where we were. So the Good Oil Conference 21 numbers there on the left-hand side, and I was using $65 a barrel, and, you know, being quite, you know, out there, putting $85. And of course, all the merchant bankers, if you look at their estimates now, they've got like begrudgingly sort of $85 a barrel, but over the long term, they've got like something like $55 a barrel for oil. Now, I'd just like to know when the price of oil is going back to $55. And so I've done it with $105 on the green on the right-hand column there. And basically, I'm saying that if you look at Woodside down the track, 2024 onwards, with Sangomar online, Scarborough coming online, more Gulf of Mexico fields coming on, Woodside producing 200 million barrels of oil equivalent per annum, then you're looking at a company that's going to be generating a free cash flow of about 19 billion, earnings per share of over $6 a share, a dividend. I mean, they paid $1.58 Australian in dividend already for this half. And I'm saying, well, you know, even at $85, they should be paying over $2.15 in dividends. And a dividend discount model that puts a valuation of about $36, $37 a share on Woodside. And if the oil price were to be $105 a barrel, and of course, you know, Woodside's actually a gas company, 75% of their profit comes from gas. Of course, the gas prices are not $105 a barrel, but like $305 a barrel if you look at on an energy equivalence basis. So I think it's still quite an attractive place to be. So how's this transition going? Fossil fuels likely to peak by 2030. There's a long plateau. All of the rebuildable power supplies still have to come through. And really, as I said last year, BP is saying that by 2040, 40% of the energy will still be coming from fossil fuels. And that's really, you know, the truth of it, that even though a lot of the investment is going into rebuildables, the winds and the solar and bioenergy, the new rebuildable energy that's coming on is not enough to meet the expanding demand. So there's still an expanding demand for gas and oil, even though coal might have peaked. And so what's happening out there in the field? And this is the world rig count. And you can see in 2015, where the Saudis were pumping like crazy to try and kill off the shale gale, that pushed the oil price down. And then number of rigs drilling fell away through 2016-17. And then we had a big drop in the pandemic as well. And the rigs have come back up, but they're still not drilling enough to actually replace the reserves that we're using. We're currently using about 33 billion barrels of oil a year, and we're just not finding that much oil. And this is Australia. And on the left-hand side, you see the drilling, the number of wells being drilled in Australia, and this is from APIA. And the light blue is the offshore drilling, and the dark blue is the onshore. And you can see that, again, where we saw a big decline in the amount of drilling, especially in 2015, 2016, just fell away to sort of nothing. We had a bit of drilling, of course, in the Otway, in the Perth Basin and the Canning Basin, and the onshore drilling, of course, was also ongoing in the Cooper Basin, but virtually nothing in the offshore, only basically what we heard from Carnarvon. They've done a bit of drilling. And so the middle chart just shows you the amount of gas, domestic and LNG. The dark is the LNG. Domestic gas consumptions remain fairly steady, and there was a big jump up in LNG output from 2014, 15, 16 to 17, as what I like to call the Gladstone cluster came into operation. And you can see on the right-hand side that domestic gas consumption's fallen from about 600 petajoules per annum to about 550 petajoules per annum, and 70% of the gas that Australia produces on the East Coast is actually exported as LNG. So there's no gas shortage in the East Coast of Australia, it's just that we're exporting it all. And this is what the EIA thinks. Now, global oil demand is about 101 million barrels of oil a day. But recently there have been some further disruptions beyond COVID, beyond Putin and anything else. There's been civil unrest in Libya, 2 different presidents fighting it out. In Iraq, people like to go swimming in their president's swimming pool when they step down. It happened in Sri Lanka, it's happened in Baghdad as well. We've got Putin's war, we've got inflation, we've got rising interest rates, we've got this energy transition, which everybody's trying to manage, and everybody's being very ESG about it. We've got global pandemic, we've got climate warming, floods, droughts, fires, looming food shortages, and of course, all driven by overpopulation pressures, and which is infecting all of the others. So I'm not sure we're going to see those numbers from the IEA come to impact. What I'd like to point out here is the fact that this is America's LNG exports. You can see them ramping up big time there from 2016, from basically nothing in 2015. But interestingly, just a couple of months ago, when the Freeport LNG facility had to close down, the Henry Hub price fell. It was about $9. It fell to $6 because if the Freeport plant is not exporting LNG, this means there's more gas in the domestic market. So the solution to Australia's high-priced gas on the East Coast is not to export quite so much, and the price would go down. And so here we are in the Anthropocene. We've got, as I said, floods in Pakistan and Europe and Australia. We've got heat waves in Europe and China, drought all over the place, wildfires in North America, in Europe, in Australia, energy unaffordable, crops are failing, scarcity war, forced migration. And the graph on the right here just shows the blue line is the human population and the red line is the millions of barrels of oil. And, you know, I think that we've been turning oil into food for the last 100 years, effectively mechanization, fertilizers, pesticides, irrigation, all of which rely on energy. And that's why the population is, I mean, that's quite an alarming graph. And here's Australia. You can see, as I said, back at 2079, we were just about 15 million, currently 26. We've got real wage growth has slowed. We've got increasing accommodation costs. We've got budgetary pressures, trying to build this infrastructure which can't keep up with that population rise. We've got increased emissions, noise, pollution from light in the air and the water, all of which is lowering the quality of life. The only people who benefit from rising population is basically Bunnings and Coles and, you know, the sort of 1%ers who can fly in their helicopters down to Margaret River and they don't have to put up with the congestion on the roads. So population is causing, I mean, people say, oh, we've got a skills shortage. We need to increase the population by immigration. But, you know, we've had a skills shortage since 1788, apparently. We've been bringing people in. It's actually the population growth, which is the problem masquerading as a solution. So, I mean, it's like, you know, oh, we've been ramping up immigration for the last 20 years and we've got this skill shortage still. So you would think like you do the same thing and expect a different outcome. No one's actually twigged that actually, in fact, population growth is causing the skill shortage. I mean, whenever a skilled worker comes in and works for $53,000 a year, even though the average is like $86,000 a year, they might come with a wife and children. So they're actually creating more demand for goods and services than they meet. And so the energy cost, you know, what we see is that when energy cost makes up about 10% of the GDP, you get a recession. And this is what we saw ahead of the global financial crisis in '88. And that means that when the oil price is equivalent to 5% of the GDP, we also get a recession. So that's what we should be looking out for with the energy costs so high now that flows through into a global recession. So just finally, where should we be looking? This is pretty much the same as I said last year. It's the new energy commodities, lithium, graphite, graphene, copper, nickel, cobalt that go into the batteries, the rare earth elements, and we've seen companies like Hastings getting in bed with Twiggy Forrest. We've got battery makers, the wind project developers, the pumped hydro, even GenX has come up against a bid by you know, the billionaire tech guy. And so there's lots of interest in the renewable energy sector. And I think there's going to be still a lot of money to be made in the energy sector with companies like Woodside that have got a lot of, and you know, these companies are not doing much in the way of exploration. They're all about basically milking their existing assets. And we've just heard from Horizon, which is basically doing that. No one wants to really spend money on this high risk exploration business. It's all about producing and cash flow from existing assets. So that's it from me, Chrissy. I took some liberties. I went over the...
We're just having a debate out the back as to whether I should ding you or not.
No.
That's what I thought too. I did think it would be rude.
Don't laugh.
Some thought, no, you can, yeah, that's exactly right. Would you put your hands together again, please, for Peter?
Thank you.
That was a great, insightful way to finish off our conference, sir. I've snapped a few of the screenshots on my phone to go home and play with the kids with after. My kids love investing and they love when I come home from this conference. It's very bizarre. I've got a 17-year-old who's got a nice little portfolio that he started amassing during COVID, so he's stoked with any information. We will be back here tomorrow with a conference with a slightly different title, but if you'd love to come and join us, we would love to have your company. And I did like that comment that one of our presenters did today. Well, Eric quoted Mark Twain. He said, "The reports of my death have been greatly exaggerated." And as Peter just pointed out, we cannot afford at this point in time to give up oil and gas. So let's see if there is a little bit of a runway of opportunity for us over the next 10, 20 years. And let's make use of it. Thank you so much, everyone. We love your feedback. Please give it to us. And we look forward to seeing you again in 2023, if not tomorrow.